Welcome back to Markets Today. We are discussing the budget-making process in Kenya, a process that takes 12 months, and from tomorrow through to Friday, there will be the element of the public participation, where the Cabinet Secretary, Mr. Okoru Yatani, I beg your pardon, and the Ministry of Finance will be listening out to the public to hear their commentaries when it comes to the budget-making process. This budget is expected to be read on 11th of June, the year 2021, but it has to go through a couple of checks and balances to ensure it's balanced and it actually had as many voices as possible. If you are just joining us, karibu sana, we are talking to Mr. George Munga, just trying to unpack this particular budget. Now, we want to get into the debt element. Debt is a key thing when we're looking at this budget. From the local press, we have seen that up until now, the revenues that have been collected in this year, 54% of these revenues have gone to service debt. When we look at the continent of Africa, we are in a cycle where Zambia has already defaulted on paying back its foreign debt. The debt holders have declined that, and it's a back and forth. And just earlier today, Rwanda came out and said to the Ministry of Finance that the risk of default has moved from low to medium. The key question with Kenya on debt is this debt sustainable? Can they keep paying it back, especially the foreign element of debt? Now, let's try and understand this, George. With that background and with the budget process and with your own analysis of this, where do we stand? Revenues are declining, debt is increasing. Are we going to default or not?
I think with the, even as if Moody's was to rate us today,
yes,
then we'd score lower than what we scored in 2018 or 2017. Remember, in 2013, our debt, our total debt was 1.8 trillion
yes,
shillings. Currently, we are at 7 trillion shillings. And the other day, a parliament reviewed our debt ceiling to 9 trillion shillings. I bet you not that probably by the end of next year or the other year, we might hit 9 trillion shillings. So our debt has been growing by almost 100% almost every year, yet our revenues are growing at probably not more than 10%. That is not very sustainable,
okay,
even for a private company. If you keep on accumulating debt and not growing your revenues to match your percentile growth in debt, then sooner or later you'll be in a big problem. I was reading in the dailies today that Treasury restructured some of their local debt portfolio. That is the Treasury bills from
yes,
now a total of 20.1 billion shillings into infrastructure bonds for I think 6-7 years. Those are pointers that already the government is not able to finance its maturing obligations as they come in. I think it was last week that the government had requested IMF to restructure their 75 billion debt into a longer term bond. Those are not very good pointers. So I think the risk of default is imminent. And if government doesn't manage our debt portfolio well, then it might be with us here sooner rather than later.
Okay.
I think probably by 2021, if you don't manage our current debt portfolio, then you might start hearing those alarm bells from our debt holders,
okay,
and from the credit rating agencies like Moody's. But that notwithstanding, Mwema, there are still things that the government can do to salvage the situation.
Sorry to interject, Judge. Before we get into what the government can do, I like that element that you're giving us. If 1 year, it's really a short-term period for us to evaluate and see. But then on the flip side, Mr. Yatani has publicly come out and said, we can manage the debt. It's not reducing. He just says that it can be managed by increasing the tax base or increasing the revenue collection internally just to be able to service that. How does that compare? How are we going to manage it even before we start thinking about 1, 2, 3 things? Because, as you rightfully said, we are not getting into a space where we're moving from a 7 trillion and saying we want to move to 5
trillion, correct.
We are at 7 trillion and
higher.
Parliament has given us the green light to go to 9 trillion. Then you are saying that we'll get to 9 trillion in maybe 12 to 18 months. Yet, we are not raising enough revenue. So, what is happening, and really what are the risk factors as a business or as an investor in that light?
I want to say this, Mwema. If our debt was growing at the rate at which it has been growing for the last 10 years, and our GDP was growing at say 10% or more every year, then I would not be worried. But our debt has been growing by double digits, yet our GDP has been growing by, I think the highest we achieved was 5.4%.
Yes.
This year with COVID, it might go down to 3 or 2%. So you can see that there is a huge risk of our default, our default on our loans. Most of the investors would still want to invest in Kenya because Kenya is a good name.
Okay.
But the risk that the country faces with that kind of situation is that will attract very expensive debt. And when you do that, you push yourself into what we call a debt trap, so that you borrow from Paul to pay Peter.
Exactly.
You cannot be able to pay your debts from your revenue collection, and that can only proceed for some time, maybe 1 or 2 years. If you look at the story of Greece, where what happened before they reached where they reached, the revenue growth could not match the debt growth. So it reached a point where they had to borrow from this lender to pay off this lender, and eventually all the taps were closed.
Okay.
And the economy could not hold it. So before we reach there, Mwema, I think Treasury must open their eyes and look at the bigger picture between now and the next 5 years, between now and the next 10 years.
Okay.
How is the economy likely to look at, and what can we salvage now before we can reach into a point of no return? I was talking to you off air that sometimes the government goes into the market and borrows, and they call it budgetary support. What they simply mean by budgetary support is that it is going into recurrent expenditure. It is not going into any development expenditure. And when you borrow to finance your recurrent expenditure, then the risk of not getting enough revenue to repay that loan is quite high, because then that loan has just gone in purely into consumption without going into development.
Okay.
So I think those are the areas that the government must start looking at now. Remember, in the 1990s, when we were not able to pay some of our maturing obligations, IMF and the World Bank came to us and forced us to take the structural adjustment programs. I don't know if you can
yes,
remember.
I can remember.
And they were very bitter pills.
It was a hard time. There was just you could actually feel there was no money in the economy.
Correct.
Okay.
That is where we might end up in if we don't manage our finances now.
Okay.
Because when you reach a certain point, the lenders now gives you conditions that you must accept before they lend you any other money for you to survive. As in, when you go to the market, it's not now under your terms, but under the terms of the debt holders.
And these terms are actually becoming.
I think that is something that Treasury must start managing right from this point. Correct.
Because, I mean, when you say terms, these terms are already becoming quite prevalent, because for the last, I think, 12 or so months, actually longer than that, the World Bank and IMF have been talking about your tax base. You need to increase your taxes as a percentage of key parameters. And it's always tax more, tax more, tax more. And today we are in a space where the government of Kenya is saying, they are speaking to the IMF and they are also speaking to the World Bank, and they are looking to raise $2.3 billion and $1.5 billion respectively from next year. So what does that mean? Because when I look at that, I'm like, okay, I'm going to be taxed more. When I look at that at an individual, it tells me if you are employed and have been paying taxes at 25%, it's a matter of a very short period before it goes back to 30. If it's a company that you're running and you've been paying 25, it's a matter of a very short period before you go back to 30.
Correct.
And over and above that, as an individual, they will start paying taxes on consumption, taxes on movement. Like every single thing that you are doing will be taxed in one way or the other. How do I look at it then as a business or as an investor?
I think I would want to put it this way before I comment, that no country has taxed itself to prosperity.
Yes.
That I think any economist will tell you that. So you cannot tax your citizenry to a level that they cannot sustain themselves, they cannot sustain their business in that economy. So, in as much as the government wants to increase the tax base, they can only do so up to a certain level. And when your taxes are so high, you don't attract foreign direct investment, because your tax policies are not favorable to FDIs. Already we can see pointers towards government wanting to tax almost everything. Remember the other day they said they want to tax even loss-making companies, so that you pay what we call turnover tax on whatever revenues that you've earned in a specific year. We also have the digital economy tax at 1.5%. So essentially, as a country, where Kenya is heading into is it's going to tax almost every aspect of your life, and that might not spur economic growth as it were, because you'll find that if you are in a business that maybe you are earning a return of say 30%, and the government wants to take 30%, then you'll not have enough capital. You'll not grow your capital fast enough to be able to expand.
Okay.
So that is a risk inherent there. And what that again portends is that even the few companies that we have locally might want to look into other countries, so that they produce in those other countries, but ship their production. I mean the products back to Kenya. So what you're essentially doing is you are exporting your employment to other countries as opposed to employing your youth. That is where unemployment comes in.
Okay.
That happened to the US. Remember, between the US and China. Remember, most companies shifted their operations from the United States to China. One was because of the tax issues, and of course the employment policy issues. So those are issues that any economist or any serious government must look into before they say that we want to improve our tax base from this level to this level by taxing the citizenry even more.
Okay. Mm-hmm. I know we're talking about many things. It's not very, when you're talking about the budget and looking at the investment case, it's not really a straight line. It's a matter of what if and balancing lines. Correct. Let me take a different trajectory and just throw a spanner in this conversation. So we have the government that's going through a budget making process. It has to contend with the element of debt, and now it's looking to external partners to be able to help it bridge the gap in terms of financing its day-to-day expenditure. That comes with strings attached to it. Now, on the flip side, the same government, when you look at it, when you look at companies on the NSE, they tend to be a proxy of really what's happening in the economy.
Correct.
And I know we are all getting back to a much better place now. But when you look at the likes of Safaricom, when you look at the likes of the banks, not good numbers, it's negative growth. But then the key anchor in some of these big industries is the pronouncements by the Central Bank of Kenya. So I want to come to the element of balancing fiscal policy and monetary policy. I cannot say that the pronouncements by the Central Bank of Kenya in terms of capping, or the saying for certain transactions they will not be charged, or their influence in terms of how banks report, especially with element of the non-performing loans. But from where you sit, what is central bank doing, and is what central bank is doing, how is it aligned to what then Treasury is doing? Because we're trying to understand the case for Kenya. You have companies that are reporting negative numbers. One way or the other, they have been negatively impacted by decisions made by the central bank. Then you have Treasury that is trying to collect taxes, but it's not collecting taxes because these companies are not growing in their profitability. So then that tax base has already shrunk by itself.
Correct.
How do you look at these two elements?
I think Mama, this year has been unique. It's one of the toughest year in the history of our economy. Most of those policies were thought through or were pronounced to respond to COVID-19. A case in point was the tariffs on M-Pesa that were waived for certain transactions. But as we go through with this economy, I think you said it right with that sometimes you must juggle between the economy, public health, and all this stuff. So I think my response would be that CBK needs to review even on a month-on-month basis, the economic response to some of their policies. You remember, for the first time, I think Safaricom has reported a drop in their M-Pesa revenue and the overall revenue, so to speak. And when they report a drop in the revenue, meaning even the tax that KRA is going to collect from that company has to go down. So when you look at it vis-a-vis the macroeconomic aspects of the country, then you realize that some of these policies might have a negative impact as opposed to the positive impact they were supposed to have. I've seen the Kenya Bank Association and even Safaricom trying to lobby Central Bank of Kenya to review some of these policies, which I think is from where I sit, I think is overdue, so to speak.
Okay.
We are trying to collect as much revenue as possible, and that can only be possible in an economy where the big corporates at least report growth in their profits. When they report growth in their profit, then you can be able to collect more value-added tax, you can be able to collect more corporate tax, and even you can be able to collect more pay as you earn, because they'll be able to absorb more workforce into their processes.
Okay.
But when they report depressed revenues, one, they start shedding off stuff. We've seen that quite a lot this year. You'll not be able to collect much in corporation tax, and even on value-added tax. So I think it is something that Central Bank must start reviewing, probably starting this month, so that they look at the economic impact of some of these policies vis-a-vis where we are as an economy, and vis-a-vis the public health measures that the government is trying to put in place. Kenya is a middle income economy. I think we are ranked as what we call the lower middle income economy, meaning we are not so strong enough to withstand shake-ups in the economy like what we are experiencing currently.
So just started running, but we could fall at any time.
Correct. So I think planners at Treasury and even at CBK must get the act together and think on their think on their feet. Meaning, you don't wait until maybe 3 months before you can review your policies. These are policies that can be reviewed month on month as you look at what Kenya Revenue collects vis-a-vis what are the government demands in terms of spending.
So we need more collaboration. That's a very good point. So we take another short break. This is it's a heavy conversation, but it's a pertinent conversation, because I think for us, when you are looking at investments, the reality is that you and I, or anybody watching, you are either investing in Kenya or you are earning in Kenya. So it's paramount that you pay attention to what is happening with the government. In as much as we're talking about the budget making process and the onset of the public participation tomorrow through to Friday, that it might be neither here or there, it's important that you have this information. And in as much as the structure of the current process does not necessarily inculcate your particular voice, it's something that we can seek to get redress from, if not today, in the future. Right here on Markets Today, we have been discussing the process, and we've talked about key issues relating to debt. Where are we at? What are some of the risk factors? Then we've come down and we've talked about the business environment. We take a short break, and when we come back, now we want to close this conversation and say, why should you pay attention? What does it mean for you? And are there any points of silver lining in terms of looking at the way forward, either for you as a business owner, for you as an investor, or for you just as a constituent of this economy? 20146 is our SMS line. Alternatively, at Metropole TV, that's the link to follow at, or at Mbithe Mwema. We will see you after the break to come to the culmination of this conversation.